G'day Mila, so this is a great question. Who buys businesses? So I've acquired over 8 figures in businesses. There is a methodology around understanding how to use acquisitions strategically in order to grow and scale your wealth. So I'm going to run you through a little bit of why people would buy a business instead of building it from scratch themselves, and the ideas that go behind supporting the strategy of growing by way of acquisitions. So when we think about growing and scaling a business, you have the choice to bootstrap and start your own business from scratch. But we've got to realize the failure statistics of new businesses are very, very high. The statistics show that something along the lines of 80% of startups actually ultimately end up failing. And it means that even if you're a seasoned entrepreneur, you've got a great idea, you've got product market fit, there is always an element of luck, timing, and other external factors that are outside of your control that will influence your ability to achieve that particular goal. Now, when I completed my mergers and acquisitions accreditation to become a chartered mergers and acquisitions valuation and forecasting specialist, there are basically 3 key considerations for a business of whether they acquire. 1, do you want to build it yourself? You've got to create everything from scratch. You've got to create the resources. You've got to be able to build that minimum viable product in order to get to a certain economy of scale. 2, do you license it or joint venture with another party who already has it, that has certain strengths but certain weaknesses, and you can bring your strengths to the table? So let's say, for example, there's somebody out there who's already got a product and you know how to market it, you've got the distribution, then you can create a joint venture relationship and you can share in the outcome. Or thirdly, you look to acquire, that somebody has already built what you want, and in your hands, that particular business or opportunity is worth more because you know that through your systems, through your existing business, through your skill set, through your resources, that you have the ability to take that existing business and then multiply that many times over. Now, we get into the finances. So a typical business is sold at a multiple of its profitability, okay? And on average for small businesses, we're talking between 1 and 3 times profit. So if we look at that from an acquirer's terms, let's say they pay 3 times profitability, it means that that particular investment provides them with a circa 33% annual yield, assuming that the business just stays where it is. Now, of course, that business could potentially decline. There's no guarantees. That business could also grow under your leadership and under your management. So when I acquire a business, I typically will pay that between 1 and 3 times profitability. There are opportunities where you end up paying more if you're a strategic acquirer. 2, I obtain funding by way of bank finance, which allows me to magnify my cash-on-cash return. So I might only put 30 or 40% down into a deal, which basically magnifies my returns substantially. So that might take my cash-on-cash return from a 33% to a 66% return. And then, of course, I'm implementing a growth strategy into that business because I only acquire businesses that I can improve through by way of adding additional services to my existing clients, allowing me other ways to attract new clients into my group of businesses that allows me in many cases to get over 100% year-on-year return. Now, when we start talking about the big end of town, we're talking about private equity businesses, venture capital businesses, and platform companies that basically do roll-ups, essentially acquire a lot of smaller businesses, combine them together to create efficiency and basically build some sort of value proposition of them as a collective, and then going and selling them for a higher valuation. There is an opportunity of what we call valuation arbitrage. So this is why massive businesses, publicly listed businesses, pay ridiculous prices for business acquisitions, is because their valuation multiple is substantially higher than what they would pay for a smaller private business. So let's go look at the stock market. You look at the average business on the stock market, it's currently trading at 20, 25 times, potentially 30 times profitability. And that is measured by way of what's called the PE ratio. So they could go and acquire a private business for even 10 times profitability, and then rolling that business into their business, get a substantial uplift in that valuation, which basically covers all of the cost associated with funding that acquisition, particularly if they use debt to finance that particular acquisition. And it's an absolute no-brainer. Public businesses and big private enterprises have been doing this strategy for years. It's basically manufacturing growth through acquisition. And it's a really, really interesting space, and it's a space that I'm very passionate about. One of my primary wealth building strategies is business acquisitions. I also sell businesses once I get them to maturity, and I don't believe that I am the best owner of that particular asset, or it no longer poses a strategic objective for my business group. It's a cheat code for maximizing your wealth for the future, and it's one of the 3 ways that you can build wealth. There's business, there's property, and there's shares. If you understand how to build value into your business and you know how to acquire other businesses profitably, it's a great way to create financial freedom faster. Hope this helps.